Disney stock is up 24% this year, but shares have been on a bumpy ride and are still below the level they reached back in August 2015. At the current price, the company has a market cap of $204 billion. It's got $10 billion of cash and investments on its balance sheet and $48 billion of debt, so the enterprise value is $242 billion. Revenue over the last 12 months is $89 billion, with $3 billion of net income and $8 billion of free cash flow. So Disney stock is valued at 68 times earnings or 30 times free cash flow. However, Disney's valuation is not as expensive as those multiples suggest. The company is still reporting heavy losses from its streaming business in the region of $2.5 billion. So when Disney starts making profits from streaming, its earnings will jump and its valuation will appear much more attractive. However, there's a catch, because as people tune into Disney streaming, they tune out of Disney's TV channels known as linear networks. Last year, Disney's linear networks saw a 9% drop in revenue and a 21% drop in operating income to $4.1 billion. Meanwhile, Disney's streaming business grew to $20 billion with an operating loss of $2.5 billion. Let's assume profits from linear networks declines to $1 billion by 2026, but it's balanced by streaming, which increases to $3 billion in line with management forecasts. And let's assume that Disney's parks segment continues to grow at an annual rate of 12% per year. In that scenario, Disney would be making $16.5 billion of operating income in 3 years' time. Account for debt, and based on historical margins, net income might be around $11 billion, and a PE ratio of 25 then takes the market cap to $275 billion, which works out to an investment return of 11% per year plus dividends. That return relies on a few things going right. First, that Disney's streaming business grows at a good pace, at least 15% per year, with operating margins of 10 to 12%. Second, that Disney Parks continues to grow without a slowdown. And third, that Disney's performance is rewarded by investors with a higher valuation multiple. Activist investors are trying to move the business in the right direction, and Disney should be able to use AI eventually to drive down the cost of content. But it's that third point that may be the stumbling point for Disney's stock. A bloated balance sheet and questionable culture means the company has a lot of work to do if it is to regain investors' trust. But these are my personal opinions, not financial advice, and I hold no position in Disney stock. For more investing videos, make sure to visit my website, 3minutebreakdowns.com. Thank you for watching.